Hello everybody, it's Yashar here, back again with another video, and in this video I'm going to summarize the Canadian bank stocks earnings report which came out last week and compare these reports for the 5 largest publicly traded banks in Canada. I divided these earnings report into 5 categories of great, good, okay, bad, and disaster, depending on the numbers and future forecasts reported in these earnings for each bank. I personally invested in 3 Canadian banks, TD Bank, Bank of Nova Scotia and EQ Bank, and that's why I read the earnings report of Canadian banks carefully and follow their news. If you want to see the detailed valuation analysis of each of these companies, you can watch my previous video on valuation of Canadian bank stocks, which I will leave a link to that video in the description box below. I will start with the CIBC, which is the 5th largest Canadian bank by market cap and the smallest company in this list. And I think their earnings report was a complete disaster. They started this report with a very odd statement of, "We delivered solid financial performance and furthered the strong momentum across our banking through the execution of our client-focused strategy," and so forth and so on. But this doesn't make any sense based on the numbers reported in this statement. Their adjusted net income, their adjusted diluted earnings per share, and their return on equity went down compared to Q4 2021. Particularly, the adjusted earnings per share was down 17% year over year, which is terrible. Their net interest margin, which is an important profitability metric for banks, also went down from 1.58% to 1.51%. Their dividend payout ratio is now increased to over 50% to 59%, which is not a good sign for a bank stock. Their asset under management and assets under administration is also down year over year, which means the investment section, the investment firm of the business is not also in the best form either. This happened while they increased the number of headcounts, the number of their employees by 5,000 year over year, which means more cost for the company in the future. So pretty much all of the main numbers are down year over year and quarter over quarter. So I'm not sure which part of this performance was solid. It was really bad. In addition to this report, there was also the news about New York court ruling against CIBC, basically added to the fuel to the CIBC challenges. Basically, in the next quarter, they have to recognize another provision loss of almost 1 billion Canadian dollar due to the lawsuit of Cerberus Capital Management related to a transaction with CIBC during 2008 financial crisis, which puts more pressure on the balance sheet of the company in the next quarter. Despite all of these challenges, CIBC raised its quarterly dividend from 83 cents to 85 cents per share, which I don't really like it, honestly. Overall, I think this was a disastrous earnings report for CIBC and the shareholders, and the share value of CIBC stock went down significantly accordingly after this very bad earnings report. Okay, so the next earnings report that I will cover in this video is the earnings of Bank of Nova Scotia. Bank of Nova Scotia is the 4th largest Canadian bank by market cap, and I think the earnings report was okay. It wasn't great by any means, but it wasn't bad either. It was an okay report. On the basis of Q4 results in 2022 compared to Q4 results in 2021, their adjusted diluted earnings per share, net income, and return on equity went down slightly. However, on year-over-year basis, they grew their adjusted EPS and net income slightly compared to the last year. So year over year, they grew slightly. Quarter over quarter, it went down a little bit. The total revenue almost remained the same. Their net interest margin went up slightly from 2.17% to 2.18%, which is good. Their book value per share went up slightly from $53.2 to $54.6, which is also good. And the number of employees was pretty much flat during this time, which are all positives for the earnings report. So I think it wasn't that bad of a results overall. Bank of Nova Scotia did not raise its dividend during this report, which was a little bit of bummer for shareholders, but they already have a huge dividend yield. So overall, there were no exciting news in this earnings report, but the numbers were not that bad either. So it was an okay earnings report for Bank of Nova Scotia, in my opinion. The next earnings report that I cover is related to Bank of Montreal, which is the 3rd largest Canadian bank by market cap. I think their earnings report was actually bad. It wasn't terrible like CIBC, but still it was bad. Their adjusted earnings per share and adjusted net income went down compared to the last year. Particularly, the adjusted earnings per share went down from $3.33 per share in 2021 to $3.04 per share in 2022. They reported a provision for credit losses of $226 million compared with an expectation of a recovery of provision of credit losses for $126 million. And the return on equity went down to 12.9% compared to 16.5% last year. On year-over-year basis, these numbers looks a little bit better, but still not great performance by BMO. Basically, very weak financial results in terms of the growth and in terms of profitability. Their book value per share went up year-over-year, which is good, but their adjusted dividend payout ratio went up slightly from 31% to 45%. Even profitability matrix of this company was not that good during this quarter. For example, their net interest margin actually went down from 1.62% to 1.46%. Despite weak earnings, BMO actually raised their quarterly dividend by 8% compared to the last year. Overall, this was a bad earnings report for BMO, but it wasn't a disaster. And that's why BMO report will go into the category of a bad earnings, not a terrible earnings. For the next earnings report, I will look into Toronto Dominion Bank, or TD. TD is the second largest Canadian bank by market cap, and I think their earnings report was actually great. They reported significant growth in their total revenue, total equity including new deposits, a very healthy return on equity, a significant growth in their diluted earnings per share, and in basically their book value per share. For example, their diluted earnings per share went up from $2.04 to $3.62, which is a huge growth. Their book value per share went up from $51.6 to $55, and their return on equity remained the same. Their other profitability metrics were also up. For example, TD net interest margin, or NIM, was 2.70%, which was an increase of 22 basis points compared to the last year, which they mentioned is primarily due to the higher margins on deposits reflecting rising interest rates. Pretty much every single number in this report was good or great. They not only reported strong growth numbers, but also they raised their quarterly dividend by 8%, which is another great news for investors and shareholders of TD. Overall, this was definitely an excellent earnings report for TD, so TD will go to the great earnings report. The last earnings report that I cover today is related to the Royal Bank, or RBC, which is the largest Canadian bank and Canadian company by market cap. I believe their earnings report was good. Nothing great like TD, but very solid results overall. Let's look at the actual numbers. They did not really post amazing growth numbers. Their revenue and diluted earnings per share was up only 2% year over year, which I can consider them to be flat. However, their profitability matrix grew significantly year over year. Their net interest income was up 24% year over year, and their net interest margin, or NIM, on average earnings assets increased this quarter by 13 basis points to 1.56%. They also were able to increase their number of customers and their deposits rapidly, which overall leads to offsetting the effect of lower earnings growth for Royal Bank. They also raised the quarterly dividend by 3%, which is always a good news for shareholders. Their forecast included a 7% average year-over-year growth in diluted earnings per share for medium term, which is in line with their historical growth of almost 8% year-over-year. They also forecasted a return on equity of 16% and a dividend payout ratio between 40% and 50%. Everything basically in line with expectations. They also recently announced that they will acquire HSBC Canada for 13.5 billion Canadian dollar in cash, and this deal should be closed next year pending regulatory and of course shareholder approvals. This in itself means RBC is looking to further grow their market share, which can be a good thing in the long term for shareholders of this company. There you are, guys. I hope you enjoyed the video, and if you enjoyed the video and my coverage of earnings report of Canadian stocks, consider subscribing to the channel to see similar videos. Thank you for watching, and I hope to see you guys in the next video. Farewell.